quickly introduce our panelists. I'm just going to run down who they all are, and then I'm going to one at a time give them 2 or 3 minutes, 4 or 5 at the outset or at the most, to just discuss who they are, what they do, and some high-level thoughts of some of the research they've done in the past or are currently working on. Not going to get down into the weeds of the exact findings, but we just want to give you a flavor of what kind of research is being done in our marketplace, what they're capable of looking at. So starting first to my near left, we have Jeffrey McIntosh. Jeffrey is currently at the University of Toronto within the Faculty of Law. Next over, we have Joshua Slive. Joshua is from the Bank of Canada. And actually, when he introduces himself, we're just going to ask him to speak a little bit about the Bank of Canada's market structure research. They're a little different than perhaps some of the universities. Next over, we have Andreas Park from the University of Toronto. And last but not least, on the end, we have Douglas Cummings from the Schulich School of Business at York. So, Jeffrey, do you want to start off and just give us a few minutes, an introduction to what you do and some of the topics that are of interest to you?
Thank you, Doug. I have taught corporate and securities law at the University of Toronto for about 30 years now. And for the last 15 or so, my primary research area has actually been pretty much the same as Doug's, which is venture capital, innovation, and so on and so forth. I'm a relative newcomer to this area. I'm currently working on a paper for CD Howe on high-frequency trading, and I have a draft out there. I'm also a director of CNSX Markets, which has, of course, as many of you know, a listing platform and also runs pure trading.
Excellent. Joshua?
Thanks, Doug. So let me just start off by saying, since I'm trying to learn to be a good central banker, I will tell you that everything that I say here today is purely my opinion and not the opinion of the Bank of Canada, and I won't be telling you anything about interest rates. And I say that not just as a formality, but it's actually true. Neither the old governor nor the new governor agrees with anything I say. So the Bank of Canada has for a long time been interested in equity markets in Canada, but to varying degrees. And our interest has been a little bit more lately. And in fact, since the financial crisis, we created a new group at the Bank of Canada called the Market Infrastructure Group within the Financial Markets Department. And the reason for that was really a reaction to the financial crisis and the discovery during the financial crisis that markets that were backed by solid infrastructure tended to function much, much better through the crisis than markets that were backed by infrastructure that wasn't as resilient. And so we have started to focus more and more specifically on all kinds of different market infrastructure, going from the trading platforms, but all the way down to clearing and settlement and trade reporting and all of those sorts of things. We are interested in equity markets in particular because the Bank of Canada, in addition to its monetary policy role, has a role in promoting the safety and efficiency of the Canadian financial system. And obviously equity markets are an important part of that financial system. We also see equity markets as being sort of, at the market structure side, as being an early warning indicator of what kind of market structure changes we might potentially be seeing in other markets that we call the core funding markets, such as the FX market and the fixed income market. So many of the market structure issues like high-frequency trading and tick sizes and almost all the things that we are hot topics today in equity are also hot topics in these other markets. And so we can study equity markets because they're interesting on their own and also as an example to help us deal with these other markets. So I have a history. Before I was at the Bank of Canada, I was a professor, and I've done research on microstructure data, so tick-by-tick data from stock markets, going all the way back to the Vancouver Stock Exchange, which is the data that I used for my PhD thesis, and then forward to today, my colleagues and I do fundamental research on issues including high-frequency trading, dark pools, market fragmentation, and issues like that on the Toronto Stock Exchange, and the Montreal Exchange, and other platforms.
Great, thanks, Joshua. Andreas?
Yeah, so I'm a faculty member at the economics department of the University of Toronto, and I do most of my research on market microstructure, both theoretical and empirical. I've written specifically on the Canadian market. I've done some work on maker-taker pricing. I've looked at dark trading and dark orders, and I've done research on high-frequency trading, which is probably my most recent one. We've done a two-pronged approach there. One was to do a long-term study of looking at how high-frequency trading developed from 2006 onwards until mid-2012. And I've also looked at, in the context of high-frequency trading, at the introduction of the IROC per message fee from 2012. And, we probably can come to that a little bit later, what the idea there is. But, generally we're interested in not so much just looking at markets in general as an aggregate level, but the TSX has been very generous in having me look at their more detailed data, and that allows us to look at the redistribution effects that we see in the economy and in the market. And so that's a little bit of a novelty that there's not many people in the world who've looked at anything in that kind. And that allows us to get a deeper view and a more complete view of markets, and allows us to assess maybe why there can be some discontent about market participants as to, is HFT good or bad? There's winners and losers. We're trying to see, can we identify specific groups that are more affected or less affected? And that has been only possible because the TSX has been very generous in offering me to have a close look at their data. We're also trying to work on new measures to measure liquidity better, to measure trading benefits in a market better, again, so that we get a better idea of whether or not market structure changes and market structure in general is something that is positive or negative. All my research is available on my website, or at least are links to my papers on my website, and I'd be very happy if I get comments from some of you, and some of you already were very generous in giving me comments on my work in the past. Since I'm a professor, I should also briefly mention that I'm teaching mostly courses on finance, in particular also on market microstructure.
Excellent. And just to Andreas' point, if at the end of this they mention some papers, because we're not going to get right deep into the weeds, but if you're interested in either having discussions or seeing the papers, if you don't get a chance to speak to one of these gentlemen afterwards, either Kevin Sampson or myself would be happy to help you get in touch with them or find where the papers are. So thank you, Andreas. And lastly, we'll go to Douglas.
Thanks very much. Like my colleagues, I'm also a professor. I'm at York University Schulich School of Business. I've been there since 2007. Over the last number of years, actually I'd say 16 years since I was last being mentored by Jeff, I have worked at a number of universities around the world, throughout Asia and Europe and even Australia. And when I was in Australia, I got interested in topics relating to market efficiency, integrity, general microstructure topics, through which we've done a lot of comparative work. So by comparing many exchanges around the world in respect of anything from IPOs to the effect of changes in trading rules, to the introduction of high-frequency trading. So we've done a lot of empirical research based on worldwide data from exchanges and regulators that we've spent a lot of time gathering. And likewise, this work is available on my webpage and available for freely public good, as we would say in academics. And I think a nice benefit of this type of work is that we believe it's quite independent and objective, so we don't get paid to do this work. It's just stuff that we do as academics. And I guess the other, otherwise quickly mentioned, I've done work on a variety of other topics like hedge funds, private equity, venture capital, and have a number of books that recently put out over the last couple of years that's likewise available, links from my web page, and even though they cost a little bit of money, I don't get paid to do these things either. So, but I'm pleased to be on the panel with great colleagues. So thank you.
Wouldn't your dean be surprised to learn that you're not interested in receiving any money for your research activities?
Yeah, the taxpayer.
Well.
Great, thanks, guys. So Douglas, you talked very briefly. You mentioned the fact that the stuff you publish is a public good and you're independent and whatnot. Leads us to the first natural question. There's obviously a lot of people speak about market structure. It's become the topic du jour the last few years, high-frequency trading, dark pools, fragmentation. Every dealer has somebody, it seems, publishing comments on it. Some of them are very good. Some of them maybe not so much. But can you maybe give us some thoughts on the difference between the academic research and the dealer practitioner type of research? What is the value of the academic research? Why should we be reading your stuff?
Sure, I could begin with that one. I guess the main thing with academics is that we are always motivated by an incremental question on an issue that someone hasn't looked at before. And the nice thing about working with data is that you never know what the data are going to say. And so if we take the high-frequency trading example, we were interested in this issue that was frequently coming out of the news, that high-frequency traders are making market manipulation more severe and more pronounced. So more frequently observed, and the costs were quite large. And so that's, of course, an empirical question which we could get at with access to data. So we've examined roughly at this stage 24 markets around the world over the last decade, some of which have experienced the introduction of high-frequency trading, some of which have not. And we've looked at issues of how that's impacted the frequency of market manipulation, and done this in partnership with a group that creates surveillance software based out of Sydney called SMART and CMCRC. And again, we had no prior one way or the other. We're just curious as to what the data would tell us. And in that particular project, we see that high-frequency trading is associated with much less severe market manipulation, as well as less frequent market manipulation, which is consistent with other academic studies that have shown that high-frequency trading narrows bid-ask spreads and other benefits associated with HFT. And as I said, I had no stake in whether the results went one way or the other, but for me it was just something that's quite interesting and timely, and we wanted to know what happened with the data. And that's the fun thing about doing the work that we do, is particularly when you get access to interesting data sets.
Doug, can I jump in there a little bit? Because I should have mentioned in the introduction, I'm the only non-economist here, and I don't do primary research. And so there's some questions you're going to ask that I simply can't answer. I think this is one I can address my mind to. I guess one difference between academic research and industry research is obviously industry people have conflicts of interest. Adam Smith, of course, famously said business people can't get together, but they conspire to fix business. That may be a little bit of an overstatement, but every business person has a primary interest in making money rather than the public interest, although, of course, they will always say that they're acting in the public interest. Another thing, I think, is that academics tend to have bigger data sets than particular dealers, which obviously is important in doing empirical research. Academics, I think, also have maybe the time very often to muck around with things the way that private people do not, and sometimes, indeed, papers can be out there for a period of years. And added to that, there's a peer review process, and not just peer review when academics submit for publication, but putting papers out there on SSRN or other databases like that and getting feedback from colleagues, presenting at workshops. The whole process can go on for a year or 2 or 3 years, and so that I think can have a marked impact on the quality. Dare I mention regulatory capture? I think regulators in this country and elsewhere are always, I guess, subject to the difficulty of dealing with the fact, as I mentioned, that private parties have private interests. And very often, I think there's evidence that the most powerful and moneyed private parties have the ear of the regulators, perhaps, more than other smaller papers. And so I think it's very difficult for the regulators sometimes, I think, to keep a balanced perspective in view of that. And I think HFT actually is a good example, because a lot of the criticism of HFT has come from incumbents. And obviously, HFT is something which is very threatening to a bunch of market incumbents. Market structure is changing very rapidly, and money is being redistributed. And money is being redistributed in favor of HFT. And so the people from whom the money is being redistributed obviously are not going to be big fans. And I think to some extent that's where we find a lot of the criticism of HFT. So as Douglas says, we try to sort of keep a balanced perspective, and we don't have an axe to grind, hopefully, and try to give regulators and other people sort of more a balanced view, if you will.
So I have a slightly different perspective on the bias issue. Let me start from a different spot, though, which is that I think one thing that academic researchers can provide is a really good toolbox. We train for a long time to do exactly what our training is about how to analyze data and how to make theoretical models that are helpful in understanding the world. And so I think there's some value in the toolbox that we bring, and we can talk a little bit more about the tools, maybe perhaps in some of the other questions. But that's not something that's necessarily unique to academic researchers, because you guys can and do hire researchers all the time who have those toolboxes as well. So that gets back to the question of bias. So it is certainly true that industry, when they do research, you're going to talk your book. That's natural. But I would not say that as academic researchers, or in my case as a central bank researcher, I don't think we are unbiased. I think we have different biases, and those biases go around what we are going to need to get tenure, what we're going to need to get published, what we're going to need to be successful in a career as an academic. And there are some studies that imply that the majority of things that are published in academic journals are actually false. The reason being that academic journals have a huge bias towards publishing results that show statistically significant relationships between two things. If you do 50 different studies and 49 of them show, well, those two things I'm studying aren't related, the 50th shows a nice, strong relationship, it's the 50th one that's going to get published, whereas that relationship could just be there just out of luck, just because you happen to fall upon a data set that by luck happened to be related that time. So academics have a bunch of biases like that, but the biases that academics have are quite different than the biases that industry is going to have when they're doing research. And so it's very helpful to have an analysis from a different perspective, understanding that everybody has biases. The other thing that adds to that, so I think, well, there's two other things to that. One is I definitely agree about the fact that the iterative nature and the peer review process and the openness of academic research helps to increase the validity of that research, to use a strong word. But the other thing is that academics, which was sort of touched on a little bit, is that academics can take a little bit more of a long-term perspective. So we're interested in answering questions, but we're not necessarily concerned that the questions that we answer have immediate implications. So it is perfectly acceptable as an academic to do research that is not immediately useful, but that somebody else can build on to make more research, that somebody else can build on to make more research that when you put them together will be very useful. And so that sort of freedom that we have as an academic, I think, as academics allow us to do a different kind of research that's very valuable.
So if I may pitch in here a little bit. So the first thing is, we have our own interests. I wouldn't call it necessarily a bias that we have, but we have interest in how we do our research. And clearly we're more interested in a result where we find something. Publishing something where you don't find something is not publishable, as you said before. So clearly when you see research being published, the reason why you see it published is because people found something to happen. And in many cases when we do market structure research, we find that there is no relation, or there's no statistical significant relation, and all that work that exists you don't find published. So in that sense there's a bias in terms of what you see being published. Now, another thing is, but the general ideas of what academics try to do is we do try to get it right. And in that sense, we have an overlap with what regulators are doing. We try to ask a question, we try to formulate a hypothesis, and try to find evidence for it to support it or to reject it. Either way is usually fine with us. Now, dealers have a different perspective. They usually want to get a particular message across. And to some degree, that's also known. People understand what particular dealers want to have as a message. Now, I personally find actually dealer research to be usually informative. I learn something new every time I read a research report, biased as it may be. There's something that I don't know, and in that sense, and this brings us back to the peer review process. When we, as academics, publish papers, we circulate them first. That's a very long process. But the time when we put the paper out, we usually put it out as the beginning of a conversation. And we like to have feedback. We like to hear opinions from people. And in particular, industry, given the nature of the research that we do, input from industry is quite important. I learn something every time. And my research agenda, to some degree, has been highly influenced by the opinions that I got from people in industry. So we have a certain intellectual flexibility, if you want, in terms of looking at questions from a different perspective. So I can give you one example from my own research. From conversations that I had with David Pankow, I actually started looking at the relation and the particular effects that market structure changes had on retail traders. That was something I hadn't thought about before, and it made me actually aware of the different parts of the markets have different perspectives and have different needs and have different capabilities in order to operate in a market environment. And so that has been incredibly helpful for me.
Okay, Andreas, I'm going to throw this one back at you. Given the absolutely awesome rate of change, in particular in the equity markets in structure over the last several years, we've gone from basically one market to 10 markets in Canada. We've gone from low single-digit participation of HFTs to well into the double digits. We've added dark pools. We've added order types. We've added dark rules and new short-selling rules. How do you get to causation instead of correlation? How can you prove what change created what impact, and how can you decide what's actually driving all the various structural changes?
So that's an excellent question, and that's actually one of the core questions of all economic research or all research that we're doing, aren't we? To establish causation, that's actually something which is really hard. Now, there's a number of tools that we have in our arsenal that we can try to use to address causality. I can give you two examples. The first one was I wrote a paper on the introduction of maker-taker pricing in Canada, which happened in 2005. And the TSX has gone about this in a very clever way by having a control group and just starting with a small number of stocks, which were the Nasdaq Amex Interlisted Securities, and they introduced maker-taker pricing only for this subgroup of securities. And what that allows us to do was to say, okay, so here's a distinct event, and use that event as studying what the impact of this fees is. And on top of that, we also had a control group to make sure that when we look at anything that may happen to the companies that were affected by maker-taker pricing was not a market-wide effect. Another example was the introduction of dark orders in Canada, which happened in 2011. Again, it was introduced for a smaller number of securities, with the biggest securities, so there's a little bit of a bias there, but you can again use these events as a means to an end to establish causality. Another example is that you can try to run a multiple regression analysis, means you use multiple different variables, and you try to find for those variables where you're not sure, which variable affects which one. So say, for instance, dark trading. Does dark trading affect liquidity measures, or does liquidity affect dark trading? You can try to look for what we call an instrument. So that's a third variable which affects only, say, dark trading, but which does not affect the liquidity directly. And you can try to see, by the lens, looking through this other variable, to try to find a causal effect from one variable to the other. Now, these are tricks. You have to believe in them. You have to buy them. Not everybody does. So that's an important feature, too. And this is part of the peer review process. We do our analysis, and then we discuss it, and we try to describe, is this a valid instrument? Does it work? Can we actually do it that way? And then by the time this papers are eventually published, there's some agreement for, yes, okay, this is some acceptable approach, and it works. Joshua has an opinion on that too, I suppose.
Well, can I jump in here? I actually worked for the Economic Council of Canada, which some people will remember from many, many moons ago. And while I was there, I established a very close correlation between the weight of duck feathers harvested in Newfoundland each year and GDP. Well, there's a wonderful correlation without causation. But it seems to me that getting back to the first question, very often the press and sometimes the industry will stop with an apparent correlation just because of simultaneity. And so this is where the toolbox that Andreas and Joshua were talking about, using multiple regression methodology and seeing whether or not, given all the stuff that's going on, something really is subject to causation.
Yeah, I could likewise chime in. One thing that people in finance often envy are the physicists and the chemists who have a nice controlled lab in which they can run an experiment that allows them to answer a particular question. And when you're dealing with social science, that of course, which includes finance and economics and legal studies, that those experiments can't be done in a lab, so we often look for what are known as natural experiments. And so there's been something that's happened in the world that allows us to study something and actually get at some sort of causal issue. And a good example of this in the microstructure context would be if you go back a few years, in Europe, they had a European-wide directive that affected a set of regulations dealing with market abuse, and those regulations were directed centrally within Europe and then imposed on a number of countries. So that's a very, if you will, exogenous type of change. And as a result, it allows us to see how market design changes have impacts on things that we care about, like liquidity and market abuse and those types of things. So those experiments are things that we often look for that allow us to address issues, and it also sort of nicely highlights the importance of not just studying your own jurisdiction, but also looking at data sets around the world, because often if you're thinking of whether or not a market design change is going to be good or bad, that change might have already been tested out in some other country around the world, and so by having a broad international perspective, you're able to gain insights that you wouldn't otherwise have if you just looked locally.
Yeah, I agree with that. I mean, I would go a little bit beyond what Andreas has said and said I don't think that the techniques that we have themselves are I don't think you need to believe in the techniques. You need to understand the techniques. What you need to check is the implementation of the techniques, because the techniques work. It's just they have to be used carefully because they can deceive if you don't use them correctly. And I mean, so those are basically the main techniques, which are the natural experiments and the instrumental variables. There's also some other ones like that you can use in different circumstances, but those are very widely used all over economics. If you've read the Freakonomics books, those books are essentially all about the use of instrumental variables and natural experiments to solve problems in economics and other fields. The results that you're going to get when you use those techniques are not always true, because sometimes you use them incorrectly, but they provide you with more information. They're a way to get it at the causality. Another thing to think about in terms of that issue in solving the causality problem is that in addition to empirical models, we can also build theoretical models that help us to understand why things should happen. And those theoretical models, I think it's often even harder for us as academics to sell, quote unquote, those models to industry, because they can often look quite far-fetched. Because when you're making a theoretical model, you start with simplifications. You start by simplifying the world way, way down to something that is much, much simpler than the real world. But if you are willing to go along for the ride, let me put it that way, in this simplification, then theoretical models can teach us, can help us to understand how to think about complicated problems, exactly by isolating a part of a complicated problem and studying only that part in isolation. A theoretical model can help us to understand that, and that can help us to understand how the causality should flow. And it can also help us make predictions about if this theoretical model is correct and the causality does flow in this particular direction, what kinds of other things should we see in the data that can prove that that's actually what's happening.
So we've determined that academic or central bank research is independent. You have the ability to control for exogenous factors. You don't have a bias. There's a peer review process. It's iterative. You're going to get to an answer. We understand the upside. So let's talk for a second about the downside. And there is a bit of upheaval with some of it. And it really centers around the data. And the data is what makes your life possible. Without data, you can't do research. So we have, whether it is a dealer who has built a smart order router or an algo suite, we have a high-frequency trading firm that has built a strategy that they make money off of. They're concerned, obviously, that their strategy, their intellectual property is going to become known and become less valuable. Can we talk about what are the risks and the impediments? What are the implementation risks to the industry as a whole of this data? And how do you make the industry okay with you guys having this non-public data?
So if I may answer some of that, if I can. So the first thing is, I agree with you, there's a legitimate concern on the side of the dealer that people could try to look at this data and try to replicate a strategy. I personally would find that highly unethical, and I think this should not be done. And I think there's, whenever somebody gets access to this type of data, that's something that should be excluded from something that can be done with that data. But my personal feelings aside on this, there's also rules that we face as academics. At least I know this for a fact at the University of Toronto, we have very strong ethics rules. Now, this type of trading data technically falls under human subject research. Because at the end of a trade, there's a human in most cases. And as a consequence of that, the entire slew of rules that we have in Canada that applies to human subject research applies to this type of research. So in principle, you can think about it, the same type of rules that you would think would apply to human subject research in the medical sciences or in other social sciences applies to what I'm doing. Now, before I can actually start on any project with this type of data, I actually have to go through an ethics review at my home institution. This is a pretty painful process, which takes quite a while and which we at U of T at least take very seriously. So for a data provider like the TSX or in the future IROC, it's actually very important that you understand what restrictions the researchers face in-house already when you give out the data. So we have strong restrictions. I know that not everybody at every school, even in this country, has the same, not every school imposes the same standard on people simply because often they can't do it. I don't know what people do in other countries. That's an important feature to know too. So if you give data out to people from outside of other countries, from outside of Canada, I'm not sure where this will lead.
Is that a pitch to get the hot study done in Canada? Is that what that is?
Well, I think there we're actually pretty safe because it has to be on site, so nobody can take that data away anyway.
So I shouldn't send an email to Jonathan Brogard? We're okay?
Well, he would come here, obviously. No, but in general, I think, the Americans also have actually very strong ethics rules too, so there's no question about that. But I know that there were researchers who didn't want to move countries from somewhere in Europe to North America simply because they would have to go through an ethics review for any single paper that they wanted to write, and that was just too cumbersome for them. But it is important that you know who actually deals with the data and what they can or cannot do. So the rules, the ethics rules in part, for instance, what they require is that we look at data in sufficient amount of aggregation. So in that sense, actually going through and trying to replicate a strategy would be unethical to begin with. So that's something that cannot be done. So have I actually said everything? But it is important that you monitor who you actually give data to.
Yeah, I could chime in here. If you were to, at I think any of the Canadian universities, at least York and U of T, if you use data in a way that's going to compromise someone's business interests or their confidentiality in any way, that's something that would get us fired very quickly. So we have these ethics committees that make sure that people don't use data counter to someone's interests. I guess that's the most broad way to put it. And then sometimes I should also say that's for accessing most data sets. And then in some cases, to do the academic work that we do, we get data sets privately. And one stage I even signed a confidentiality agreement with some folks in Germany that said I'd pay them €1 million if I ever lost their data set. And I've never lost their data set. But not that I actually ever have €1 million, but it just goes to show how important data sets are to us that I was willing to sign that contract. So without access to data, we would be sitting in our office without anything to do, really. So this is very important that we have dialogue between people in industry and practice, and we're always, in a way, it's like being sort of a mini entrepreneur trying to figure out how to get access to your next data set, and it's extremely important. So if people in the audience have data that they're looking to have analyzed, I'm very, very happy to talk to you after the event. And actually, I'm not kidding.
No, and it's. I agree. I mean, it's really crucial to advance the public interest in advancing our knowledge about market structure, to get these types of data sets, and we can, and as academics or quasi-academic in my case, we can really we can in some ways act as a neutral source of analysis, because you wouldn't want to collect all of this. You wouldn't want to give all of this data to one particular firm, but you might give the data to a researcher who is under sufficiently adequate restrictions. And so those restrictions, I mean, it may be true that this kind of microstructure data or financial market data is among the most sensitive data that you might find in a social science department of a university. I think in medical schools, the drug testing data might be at the same level of value, of confidentiality. But the academics do take it very seriously. From my perspective, the Bank of Canada takes it incredibly seriously. I think another thing to add about this is that we do hear about issues around the sharing of data. So in the United States, there's this recent issue with between the CFTC and its former chief economist and the CME. But those issues, the issues that are identified, are issues where the proper policies and procedures were not put in place. That's a problem. So there should be policies and procedures, and those should be strictly followed. But I don't know of any case where the data was actually used in a way that caused harm to particular market participants. So there were not sufficient rules in place, but nobody was harmed that I know of because of that. And with the sufficient rules in place, I think that it's something that's very important to continue sharing data with the differently biased researchers who can give a different perspective and give a more global and long-term perspective on analyzing the data.
Luckily, most academics, in my experience, tend to be focused on ideas rather than making money. We are quite a self-selected lot, which means the propensity to steal is probably not horrendously great. But as a general matter, it seems to me there are two strategies one can use, either ex ante or ex post. That is, the ex ante approach is what you do beforehand with non-disclosure agreements or ethics reviews, contracts, and so on and so forth. The ex post approach would be probably, Doug mentioned one thing, losing your job, losing your reputation, obviously, and legal liability would be another one. I've never heard of any situation where anyone was actually sued for abusing data. It strikes me that I've never studied this, but just sort of as an anecdotal matter, it strikes me as not sort of a huge pressing problem. It could be, as Joshua said, this data that is being dispensed has huge value. But there is potential recourse through the law of torts. We lawyers are always thinking about what kinds of laws might apply. The tort of breach of confidence would actually exist, I think, to allow someone who is not in a contractual relationship with a researcher to sue them. One of the big problems in law is, generally speaking, if you don't have a contract with someone, you can't sue. If there's a contract, non-disclosure agreement between a trading venue, for example, and a researcher, some third party who is hurt, who's not a signatory to the contract, cannot sue on that. But they could sue under the law of torts for this breach of confidence. So there is some potential legal redress.
So I would say that we're kind of witnessing a lawsuit, and we won't get into it in a whole lot in Canada, just around the accidental loss of data. So that also brings its mind. It's not just, do I think Douglas is going to run with the data and go and, sell it to an HFT, but is there going to be an incident where he somehow misplaces it?
Well, I can give actually a real quick great example. So this is going back, it was about 6 or 7 years that we first did this. And we wanted to know what surveillance was being done in different markets, right? So you can imagine the value of that information, because once we knew the exact surveillance that was being done, I could have quit my job as an academic and gone and done all sorts of manipulative trading in ways that would not be detected, right? And so, but the reason why that information is valuable is that we could write an interesting paper about the value of surveillance. And indeed, we had confidentiality agreements in order to get access to these data, and didn't make use of it, and still kept the stuff confidential. And then the other thing that often comes up is that people are worried, well, what are you going to do with the data? Are you going to say something bad about my company? That kind of thing. And so frequently, in the spirit of this ex post thing, frequently we say, you gave us the data. Before we go post it on SSRN or put it in the public in some other way, you can look at it first and then read it and make sure you're happy that we haven't said something mean about anybody. And never comes up, but it's just a nice level of comfort that is provided to people.
So let's drill into that. I'm going to get to you in 1 second. I'm just going to drill into this. So let's drill into this for a second. The CME is doing a study on the E-minis, for example. They obviously have some interest in the result not being that the E-mini market is totally manipulated and there should be no confidence in it. So they're going to want to look at, Douglas Cummings is doing the study for them. They've given them the data. What are the restrictions in the contract as to what you can publish? Is it just you have to show it to them first and give them a fair chance to respond? Or can they squash results if they're not in the best interest of the CME? Or what do those contracts typically look like? And that gets kind of back to Joshua's point earlier about there's different biases. Are you incented to write a paper that they're going to allow to be published?
Like the best you can. You, of course, want to have a contract that's going to not impede academic freedom. Naturally, if you're getting, say, if you, Doug, give me data, and I find something that says something negative about you, I guess these types of things. I think ex ante we worry about that happening. Although ex post, for the most part, you write a professional paper that says something that is quote unquote true. At least we say what the data tell us. Though frequently we like to write our papers that don't say, Doug says this, or I think this. Instead, it's written very specifically to say that the only inference from the data is this, or 3 possible inferences from the data are here, here, and here, and we can't think of any alternative explanations, right? So it gets written in a language that isn't inflammatory, and it just tries to be as professional as possible to let the data speak about a particular issue.
Okay, I'm going to let Andreas weigh in on this because he's done some research, and then we'll go to the questioner in the back.
I'm twitching a little. So when we have non-disclosure agreements, apart from the fact that this is all hypothetically speaking, because non-disclosure agreements are usually also
not disclosed.
Yeah. But
is he okay to say this?
So I can see from a non-disclosure agreement for us as academics usually it's not with us, but it's with our employer, the university. And so in my case, U of T would not agree to such an NDA, which would give the other party the opportunity to restrict the publication of particular research on arbitrary grounds. Now, the restrictions that would be reasonable to put into such an agreement are such that there is no violation of the confidentiality of the data. So, for instance, this example of, us going out and saying ITG does really, scruffy things. That's something that that should be something which we say this is a breach of the confidentiality of the information that cannot be said. This is why we normally, if you look at any academic paper, the data is aggregated, right? So you have, even if you look at individuals, you put 10, 20 people in there just so that you can actually not reveal who the people are. This is, again, goes back to the research ethics. These research ethics actually are very explicit in the sense of you cannot present data or data points in any way which would reveal or which gives the opportunity to understand who somebody is. Now, when we talk about HFTs, there could be 30, 40 companies on that, so that's okay. We're good with that, right? But saying something about ITG specifically, that would just be out of bounds.
Some more bucketing. Okay, we'll go back to...
Andreas may have actually addressed the question because as going back to confidentiality and the use of data, obviously you might be personally liable, but really the question is, since you guys aren't really that wealthy, nobody wants to sue you, what about the institutions you work for? In other words, if you spill the data, can I go after U of T?
Yes. That's actually the way it usually works, because the contract is with U of T. So, in principle, you can go after U of T. I shouldn't say.
Yeah. No, I mean, that's true. I mean, it just emphasizes the fact that even though there's a contract, that you can't actually sue the researcher in contract law because the researcher is not a signatory to that contract. So that does give the university, in theory, some incentive to make sure that you're...
Well, that would then encourage them to supervise heavily. Right?
Yeah.
Much like the private sector.
Yeah.
U of T is also much richer than I am.
Yeah.
Stephen?
Gentlemen, what about access? So supposing you have access to, say, NASDAQ data. You do a study. If you did a study that was counter to, say, their business interests in terms of conclusion, how likely would it be that you would be getting data from other trading venues in the future?
I think that's a very good question. I mean, this is something that's been a problem, obviously, in medical research. And I think it could happen in any area. If you are a repeat player and you want continued access to data, whether from that one provider or another, obviously there could be an incentive to, whatever.
Although most data sets don't lead to unambiguously bad conclusions. It's frequently the case where you're able to see some good things and some bad things, and so it is pretty rare to find something that's everything's unambiguously negative that's going to impede future data access. And hopefully the things that are found as well are things that are helpful for guiding what the person that gave you data in the first place might want to think about or change in the future.
So I mean, this is basically the academic equivalent of regulatory capture, and it's certainly an issue. I don't think it's as much of an issue as it is with regulators because academics have a lot of choices. They can turn to a different way of looking at the problem. They can get data from different sources, and if you get one really good hit with a paper that can make your reputation as a researcher for a long time, for example. So you'd probably be willing to do it even if you were burning some bridges in that case. But there's always going to be conflicting incentives, and but it's also about working together with industry and with the platform. So you also don't want your academic researchers to be off in their ivory tower, not talking to anybody and not interacting. So some amount of things that could lead to capture is a good thing, so that we're well informed about the perspectives of everybody in the market, and so that we understand what the real issues are, and we're not analyzing the data without its context.
Now, Andreas, I know you want to get in here, but I'm going to cut it off there. I'll give you the first shot at the next question, though. I want to get in the last few minutes as the clock's ticking down, is into the future of the research, and really what role it plays in the future of regulation. So even if we do 14 blind tests, we control for all the exogenous factors, and we go back to the OSC, we go back to IROC and say, if you implement this rule, we think X is going to happen. There are so many variables we don't really know. How should regulators be using the research? Should it be before a rule comes into place? Should it be after? Should it be both? What do you guys, and just go kind of down the line, maybe start with Andreas and we'll go to everybody. How would you like to see this research used by regulators and marketplaces?
So the first thing is that the OSC already committed to evidence of fact-based policymaking. And in that spirit, I think the way to do it, or the way to go forward, is to, at the very least, take data as an input. and do analysis and take it as an input, as one measure. It's not, academic research is not a silver bullet. As I said before, it's not always conclusive. It doesn't give you always all the answers that you want. There's no certainty. What you, in some sense, what you want to do can do with that is you do no harm. Right? So you can use it to get a better sense of what one is doing, and you can get a more informed decision. So in that sense, it would be reasonable to either before, if you can, think about what would be the parameters that we need to see in the data after we do an implementation that would render this a success. One option would also be to run pilots, to take natural experiments, or in some sense make an experiment. You take a random group of companies that you impose a change on. I'm not sure if this is legally possible, but in an ideal world, this is what you would be doing. You try to make a sample group, try to see what happens, and then see whether or not you want to use that for the entire market. In some sense, the TSX has done that with some of their policies. So in that sense, you should use some form of analysis in your decision making. Now, doing that is a completely different question because it is very difficult to do, it's expensive to do, and the regulator IROC and the OSC both have to ask themselves some question of how far do they want to push this and how do they want to implement it. There's a number of ways how you can do that. There's people who would be willing to give opinions, and not just me. There's also Ryan Reardon here in the audience. There's a lot of people around town who are actually interested in seeing how the future of data analysis goes as far as markets are going. But it is an important piece of information. If you want to make everybody here, you all work on data, right? Nobody works on gut instinct anymore, I hope. So if you do an analysis, if you do make a trade, you want to know in advance of, have some idea of where you're going with that. So it's natural.
Douglas?
Yeah, well, I couldn't agree more. I'm, as everyone that knows me knows, I'm a data guy. I love working with data. Evidence-based policy making is very important and informative. People can look at data sets from around the world in order to gain insights into the impact of regulatory design changes, among other things. So I think it's very informative. And to give a quick analogy, it's like the money ball for securities markets, right? So by looking at statistics, you can actually learn a lot, and much more over going by gut instinct. And so by using these techniques and these studies and knowing what it is that you're looking at, so having some rigor attached to the data analysis can be extremely helpful and informative. And the more of that type of work there is, I think the better off we'll all be in the spirit of benefiting everybody's mutual collective interest. So I think it's a good thing.
Joshua?
Yeah, I think the things that we talked about at the beginning, as far as the tool sets, the different set of biases, the openness and the iterative nature of academic research and the long-term perspective, all of those things are crucial to good policymaking. And that doesn't mean that the academic results are going to directly relate to policy decisions, and it certainly doesn't mean that they're always going to directly lead to correct policy decisions. Mistakes are going to be made. So I think it's also very important to think about having policy that is adaptable and being prepared to change as you go, as you get new data, as you learn more, being prepared to change. And one of the ways to do that is through pilot projects, which have been used in Canada. The TMX has done their penny pilot, and the TSX has introduced new features as pilots, and it's being considered in the U.S. And I would encourage you, if you're going to do pilot projects like that, to do them in a way to consult with academics who understand how to control for endogeneity, how to control for problems in causality in those kind of projects.
Jeffrey, you get the last word.
Historically, policy making in Canada, at least in my sphere, has been empirical. The SEC has had an Office of the Chief Economist for decades. The CFTC has an Office of the Chief Economist. So they're taking this research very seriously, and they're actually making policy on the basis of it. Some years ago, the OSC established an economist office. I don't think that exists anymore.
It does.
But it does, okay. It strikes me that in many ways, policymaking is still empirical. And the example I'll give is I was speaking on a rather different topic last week, poison pills, and a lot of people in the merger and acquisition industry have been complaining that the pendulum has swung too far in favor of bidders rather than targets, which is sort of a strange argument to make when you look at the empirics, that bidders are actually on average losing money. All the gain in takeover bids seems to go to targets. And that was, the OSC has not considered those empirics. IROC, to its credit, is now undertaking this major study of HFT, but I really would like to see more close connections between our policymakers and the terrific talent that we have in our universities. I think part of the problem, and I'm going to slip my throat a little bit here in saying this, is that lawyers make policy. I'm a lawyer, but the problem is a lot of lawyers, I think, just don't want to listen to economists. I think there's some sort of fiefdom little thing going on here, and I'm sort of saying something against my own interests. But I think in part it is the fact that it is lawyers primarily who make policy, and they just simply have to get more used to using empirical stuff to inform their regulatory decisions.
Well, I think that's certainly going to be the trend in Canada. We've already seen IROC is leading the world in terms of data sets, which is laudable and something all of us should be proud of. The OSC is going down the same path. Hopefully they can do it together so we can pay for one data set instead of two. I want to thank the panelists who presented this very interesting stuff, and I want to thank the two Kevins and Deanna, the rest of the TMX, for inviting us. I think we're going to go to a quick break, and then we're going to be back with the regulators will be up here, and they can tell us what they think of The Economist. Thank you very much.
FTC has an office of the chief economist, so they're taking this research very seriously, and they're actually making policy on the basis of it. Some years ago, the OSC established an economist office. I don't think that exists anymore, but it does. Okay. It strikes me that in many ways, policymaking is still empirical. And the example I'll give is I was speaking on a rather different topic last week, poison pills, and a lot of people in the merger and acquisition industry have been complaining that the pendulum has swung too far in favor of bidders rather than targets, which is sort of a strange argument to make when you look at the empirics, that bidders are actually on average losing money. All the gain in takeover bids seems to go to targets. And that was, the OSC has not considered those empirics. IROC, to its credit, is now undertaking this major study of HFT, but I really would like to see more close connections between our policymakers and the terrific talent that we have in our universities. I think part of the problem, and I'm going to slip my throat a little bit here in saying this, is that lawyers make policy. I'm a lawyer, but the problem is a lot of lawyers, I think, just don't want to listen to economists. I think there's some sort of fiefdom little thing going on here, and I'm sort of saying something against my own interests. But I think in part it is the fact that it is lawyers primarily who make policy, and they just simply have to get more used to using empirical stuff to inform their regulatory decisions.
Well, I think that's certainly going to be the trend in Canada. We've already seen IROC is leading the world in terms of data sets, which is laudable and something all of us should be proud of. The OSC is going down the same path. Hopefully they can do it together so we can pay for one data set instead of two. I want to thank the panelists who presented this very interesting stuff, and I want to thank the two Kevins and Deanna, the rest of the TMX, for inviting us. I think we're going to go to a quick break, and then we're going to be back with the regulators will be up here, and they can tell us what they think of The Economist. Thank you very much.